Hi, I'm Dr. Anthony Edwards, and I'm the instructor for Higher Education Finance. And today we're going to be talking about capital budgets and debts. So, first question is why use debt? Well, it allows you to fund projects that maybe are unrelated to your operating, finances. So, things that are maybe outside of the scope of instruction. Also, you get to spread your cost out over time. You get to do some depreciation, so that can be advantageous. So, the chapter talks about a couple of different types of bonds that colleges can issue. One is general obligation bonds, and the other is revenue bonds. So, general obligation, as the name suggests, it's backed by kind of like the full faith and credit of the institution as a whole, right? Now, revenue bonds are typically only backed by revenue and usually from a particular source. So, the chapter gives the example of residence halls. And in the case of the residence halls, if you're going to take out a bond or issue a bond rather to get the money you need to build a new residence hall, it's typically going to be issued as a revenue bond where the bond is backed by the revenue that residence hall generates. So you would be using revenue generated from the residence hall to pay back the loan. All right, so you may have seen, these terms credit ratings. You may have heard of S&P, Moody's, and Fitch, and these are ratings organizations. They rate companies, but they also rate colleges because, in this sense, they're rating issuers of debt, right? And colleges can be issuers of debt, as we'll talk about in a minute. And you'll see these like S&P tends to do all capital letters, and it just varies by the number of letters. And Moody's tends to do a combination of capital and lowercase letters, but generally generally the ratings in the A's are the higher ratings, and any rating that has a B in it is generally called speculative. Okay, so you're probably going to have if you have a speculative rating, it means you don't necessarily have as good a relationship with debt as, or you may not have the great debt to income ratios as we talked about in the previous chapter as ones that are getting the higher ratings. Okay, and may as a result have to pay out a higher interest rate on that debt. And the institutions that have ratings in the C's or D's, or C's, and then there's one with a D. Those are in default. They're the lowest rating, so they've essentially not paid back a loan, right? So they're in default status. So we're not going to get into all the different ratings, but just your A's, your B's, your C's. Okay, know that. All right. So what are some of the things that go into issuing these ratings? Well, there's 5 basic categories. One is market position and demand, so that might be enrollment, that might be the reputation of the institution, institutional quality, tuition revenue, things like that. Finances and operating performance. So again, looking at your operating ratios, your quick ratio, your current ratio, all of those different ratios in terms of how the institution is performing. Governance and management, so they'll look at the organizational structure, the board of trustees, maybe if it's a state institution, the level of interaction between the institution and the state. All those go in. And also look at the management of the institution, look at the, do they have people that they have them in the right positions, and, do they have the right organizational structure? All those things matter. The debt profile, obviously, if you've got a lot of debt already, that's going to pull down your rating, right? Because it's going to essentially it's going to change your debt to income ratio, and you may have too much debt and not enough income. The state policies and government relationships. So this one, are you in a state that is friendly to colleges, or you're in a state that is maybe politically, is going to create challenges for that college to survive economically. Is that college doing a good job of getting funding from the state? Are they getting the dollars, whether it's tuition dollars or whether they're special appropriations. Are they getting that funding? All those things incorporate together to help get that rating. So who's involved in issuing a bond? Well, you have the issuers, right? And the issuers are actually colleges. Colleges are issuing the bond, and they're saying, hey, when someone issues a bond, like if we get a government bond, the government's saying, you buy this bond, we'll pay you back interest. And that's essentially what the college is doing. You buy, if you buy government bonds or different bonds in your portfolio in a mutual fund, that company that owns that mutual fund might be buying college bonds, and they're paying, the college is going to have to pay a dividend, it's going to have to, or pay interest on that bond. You have the bond dealer, so the brokerage, investment banker folks that are managing the sale of this bond. And then you have the investors, the people who are putting their money in to give the college money with the expectation of getting a return. Okay, so these are the overall actors in the bond issue. Now, what's involved? What are the different steps? Well, I'm glad you asked. So you have to clearly establish the use of bond proceeds. And here you're kind of determining, are you using this to finance something or to refinance, or maybe you're paying off the old debt and trying to get a better interest rate. What's the use of these bond funds? Kind of like refinancing a mortgage, similar situation, right? All right. And then you have to obtain the necessary approvals. Depends on whether you're state or a public institution or private institution. The college has to choose a bond dealer. What investment group are they going to work with? And they help craft a working group, because there's probably going to be other financial professionals who are involved in the sale and managing the bond issue. There has to be a timeline of figuring out, how all this is going to play out over time. When is the sale going to complete? When are people going to start getting return on their investment, right? And how long is that going to take? All right. Next, the college will be determining the security pledge, like, what are we pledging, that as collateral, that we're going to make sure that we pay this debt off. And, what's the structure of the bond? Is it tax exempt or not? All of these different things, what is the bond? There's details on that. All right. You have to engage the credit agencies because they have to be aware of this, and it helps them to reevaluate your bond ratings. Okay. Then there's a step of generating and reviewing different documents. Okay, there's a lot of paperwork in this process. Because you're dealing with a financial instrument here. Then you have to conduct tax analysis. Based on the structure, how is this going to impact investors? Are they tax exempt or not on these bonds? It needs to be a public hearing. There has to be some transparency that, hey, this thing is, we're going out and taking debt, taking on debt, issuing a bond needs to be publicly recognized. You have to price and market the bonds. You have to say, what's the interest rate on this bond? And then you have to, put it out there, let investors know that, it's available. So let the different, brokerage houses, pension funds, things like that, know that this is available, that they can invest in it, in their funds. Then you're closing the bond issue, like you're, saying, okay, we're kind of finished, and then you've got to, obviously, if you've taken out money as a college, the investors want their money. So then you got to, disperse the proceeds. Typically, it can be over a 3-year period, and they've got to get their principal plus interest back. All right. And also dealing, with the post-closing. So, again, more paperwork, just making sure all, the ratings and everybody's notified, and just making sure that everything you need to do is done. So hopefully this gives you just a kind of general overview of capital budgets with debt. You can compare it to the last chapter, how we dealt with capital budgets without debt. So there's I think in the previous chapter, there's problems 5, 9, and 12, I believe, that have financial calculations that you can do if you want to do that. In the discussion, you're welcome to do that. So if you like this video, please subscribe, and hopefully you enjoyed the video, and thank you so much. Bye.